Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both fundamental and technical, driving markets at the moment. So whilst I just let you have a quick look at the disclaimer, I'll just run through what we hope to get through this week. We'll follow the usual format, so we'll just check out how markets are shaping up currently. Looking across the FX markets and a few other pointers. We'll also highlight actually in the sort of brief introduction, just the VIX, which is the volatility index, most of you know probably, and the introduction of a new volatility index actually that the CBOE are introducing, may be a good guide for us to follow, to watch that volatility, key volatility, it's basically a shorter volatility index, the one-day index that they're introducing today. So that could be useful. So we'll just run through that. And then we'll look at US stocks in general and look at how they're shaping up, obviously, with this massive week of earnings coming up. And we'll look at some of the technicals around the S&P, the NASDAQ, the Dow, and also the FTSE at an interesting point, just stalling after its quite astounding sort of V-shaped rebound, really, from those lows only a few weeks ago. Then we'll just, as I say, follow the usual format. So we'll check out some of the really important UK data out of last week. That's really cementing a Bank of England rate hike in a couple of weeks' time. So we'll just run through some of that data. We'll look at cable, of course, so that's sterling against the dollar. And then we'll run through as well those Eurozone PMI surveys from Friday, also pretty important for the ECB meeting, which is obviously next week. So a big week coming up. And we'll look at euro dollar in that sense and how that's shaping up, which is looking pretty positive this morning. Then we'll run through the big events of this week. The Bank of Japan meeting, first of all, we'll look at dollar yen. We'll then look at some of the US data, quite important, really, although some of it is slightly stale. So US GDP, which is, of course, backward looking, if you like, but we've also got US core CPI deflator, which is an important gauge for the Fed in its inflation analysis, if you like. And then we'll hopefully get on to some of those earnings. As I say, big week. A load of companies, I think 170 members of the S&P 500 reporting this week, including, of course, Alphabet, Microsoft, Meta, and Amazon. So hopefully we should have time. We'll run through just what's expected of those four tech titans and also the technicals around those four companies. Okay, just before we get onto that then, looking at next this week's data, of course, just checking out how markets are shaping up currently. I'll just pull up the VIX chart that you can see here, of course. So, yeah, firstly, well, volatility, you can see the VIX, which measures, of course, the S&P 500 via options really for the next 30 days or so. You can see that's a very low, around 17.7, long-term average, as we've said over many months, around 20, I think. And then obviously as we get towards 30, that's high volatility. But at the moment, we're below that long-term average at 20. And it's the same in FX markets, really, quite lackluster. Ahead of, as I mentioned, next week's central bank policy meetings in the shape of the Fed on Wednesday, ECB on Thursday, and then we also get non-farm payrolls on Friday of next week. So really key week for markets next week, and really sort of price is quite subdued really in a lot of markets, FX. And stocks as well. Short-term trends for FX, though, probably slightly defensive regarding the dollar, as expectations for one last Fed rate hike look pretty nailed on, around just below 90%, I think, for that. And that means probably the US dollar probably won't rally too much further and remains in its medium-term downtrend. We'll look at that when we look at the data, the DXY chart. But commodity currencies, they are under pressure as well. In fact, if I just pull up the year-to-date chart that we normally pull up, bear with me, which is here. So you can see the year-to-date performance of the majors. On the left-hand side is last week's, and then the right-hand side, I just cut that just about 10 minutes ago. We can see that commodity currencies, so Kiwi dollar, Aussie dollar, Canadian dollar, still struggling really under pressure with weaker oil prices, really despite the OPEC production cuts, of course, announced 3 weeks ago. And Brent could potentially struggle this week as well due to refinery margins trending lower. But on the flip side, of course, you've got those European currencies, so the Swissy really pushing higher, as well as sterling and euro. The euro there also making gains from last week against the dollar. So pretty much the same currencies either doing well or doing not so well. Elsewhere, we have higher yields from last week, really, after the firm April, those PMI surveys data, the survey data in Europe and the US, and they've seen actually gold then wilting really below that key psychological 2000 level. As I said, I just thought I would mention this VIX, this new index that the CBOE are introducing. So it's being dubbed actually the biggest shakeup in years for the VIX itself. So the Wall Street fear gauge, it's known as, with this creation of a new version which will track the expectations of short-term market swings. So as I said, the VIX is 30 days, but they're introducing a one-day volatility index, which is in response really to a recent transformation in the derivatives markets and really this massive surge that they've seen in short-term options trading that sparked concerns actually about the effectiveness and indeed the relevance of the original VIX. It will measure expected volatility in the S&P over the next day of trading rather than, as I said, over the next month like the existing VIX. And if we kind of think nearly half of trading in S&P 500 options so far, even this month has been in contracts that expire on the day they are traded. And short-term trading volumes have almost quadrupled since the start of 2020. So it's certainly an interesting development, an indicator that we'll watch here and one to watch out for very short-term volatility. Just to note, actually, on the sort of 30-day VIX anyway, it can be slightly misunderstood as it's not a measure of what has happened or actually the direction in which the S&P 500, which many assume. So the VIX, if you think about it, it tends to rise when stocks fall, but it can also move very sharply higher if, say, investors expect a sharp improvement in conditions, because it's about volatility rather than, as I said, direction. The flip side is that if stocks fall slowly and steadily, like we saw last year, then the VIX may remain fairly low. Of course, we're moving lower in the indices, but that doesn't mean the VIX will move higher. It remains fairly low, and in some senses, in a way, that sort of fear nickname doesn't help that much in the understanding of the gauge. Just a couple of points to note then on that. As for US stocks, just pull up the chart on the S&P 500, which is here. Let's just pull up the weekly chart that we like to look at. Let me just take off these Keltner channels and don't want to get too complex with too many indicators, because it can just feel like there's lots and lots of different lines and we can't see too much or too many of the trends. Just bear with me 1 second. Yeah, so S&P 500, of course, and US stocks in general, well, they closed mixed for the week last week. Again, a lackluster session. We've said it a couple of times already on Friday. But remember, well, saying lackluster sessions, less volatility to us means at some point that will break. So just to bear that in mind, of course. But traders really, yeah, we're all looking forward to the heart of the earnings season this week. With those tech titans really front and center. Interestingly, the Eurostoxx 50 index, just to mention, that's eyeing its all-time highs after posting its highest daily close ever, actually, and just shy of the late 2021 intraday high mark. But investors in the US, obviously assessing mixed earnings from last week, and also those political negotiations over the country's debt ceiling. Results, yeah, last week, kind of lukewarm really from Tesla, from AT&T, and we also got a warning about the health of the US consumer from American Express. And then, as I said, investors kind of growing slightly more nervous about the still remote, let's be honest, still remote chance that the US will default on its debt obligations later this year. Always gets quite a lot of noise around this. And it kind of probably means for us anyway, simply that things will get a lot worse. There'll be potentially a lot more noise around this issue, and it probably needs to get a lot worse, yes, before we get better, and before then the Democrats and the Republicans get together and resolve their differences. Looking at the technicals then, the S&P 500, this is the weekly chart, we can see is not quite able to close above the 50% mark. You can see here of the 2022 decline at 4,155. So you can see we just haven't been able to close above that dotted line. If you can just see that, which is here. If we need to really then target, if we can close above that 4155 level for us anyway, then we would target the late January high, which is that dotted line. Hopefully you can see that 4195, and then potentially also this light gray line, which is the 100-week SMA, simple moving average at just above 4200. If we just go to the daily on the S&P, you can see we're still in this ascending channel, so bullish channel really, higher highs, higher lows, just sort of tapping the lower part of that channel. Support really at last week's low around 4,113. But potentially then, yeah, as I say, we've got that 4155 and 4200 level. Really key, everybody eyeing up that 4195 level actually for well, big resistance and any move higher. On the NASDAQ, we'll go to it now, even though obviously we'll talk about earnings hopefully in a short while. But the NASDAQ on the weekly, same really as last week. So still in consolidation mode, but still, so it's consolidation move of this break higher. But at least worthy and decent that, or positive that we're closed and still closing above that 12,880 level, which is the late January high. Of course, as long as we stay above that for us, then potentially we can look towards the recent high at 13,188. This is the NASDAQ 100. And then above that, potentially, because it's looking like bullish consolidation to us, as long as I say, we keep above 12,880, then potentially tracking sideways. The longer we track sideways, the bigger the breakout will be. And as long as we keep above that support level, then potentially we can aim towards that 100-week moving average around 13,457. On the daily, you can see that tracking sideways, staying above that level. As I say, the longer we have pretty narrow ranges, range contraction, if you like, then the bigger the range expansion will be. This is sort of, on the daily at least, quite a lot of consolidation. So really sort of potentially negating that as I said, that bullish consolidation because we can't break higher. And you can see that push last Tuesday, up to, what was it, 13,196, but still not above the 13,204. Just quickly look at the Dow as well. Just go back to the weekly. We can see it was actually the first very small down week actually in 4 straight weeks of gains. Support is 100-week SMA, which is at 33,663. And then if we look at the daily, you can see kind of a bullish flag, although, as I say, the longer that carries on, then it kind of negates that pattern, at least, which is more short term really, before we get a move higher. That's a bull flag generally. So again, if we can hold above probably last week's low, which was 33,677, then potentially we can move above here, short-term resistance at 34,082. Before then we get that big dotted line for us, 34,281, acted as resistance over the last few months, and that is really big resistance to a move higher. As I said, I just want to touch on the FTSE. If we go to the weekly, we can see 5 consecutive weeks of gains, that big sort of V-shaped rebound from those lows, which tapped that fib level at, well, just above 7,200 on the FTSE 100. That was sort of late March, mid-March, and then big rebound in the FTSE. And you can see now we've just sort of on that dotted line there, which goes back to actually the May 2018 high. It's just above 7,903 there. If you go all the way back to there, you can see that on the weekly. If we just pull to the daily, you can see now we pause there. Again, bullish consolidation for us as long as we keep around this mark. And certainly if we keep around the recent low, which is 7,871. So that's near-term support, near-term resistance. Last week's high at probably 7,936. But potentially then we look at above 8,000, and then that high back in February at 8,047. So that's the FTSE 100. Okay, let's go to now just a quick review of the data out of the UK last week. For us, important, and for markets, certainly. The usual mid-month slew of data releases from the UK, and they pretty much point to another 25 basis point hike on the 11th of May. We mentioned last week bank officials kind of been sort of refused to be drawn either way before this data, and the most recent March meeting actually kept their range of options quite wide open. But as I say, that's now pretty much fully priced in for a 25 basis point hike after the data. So the jobs data, that printed strong. Employment in 3 months to February was strong. Wage growth also, that keenly watched by the Bank of England, that surpassed the consensus, 6.6%, I think, versus 6.2% expected. So still sticky, still high, because previously there had actually been clear signs that wage growth may have finally peaked. But that certainly negated by that data last week, and really wage growth sort of picking up slightly. So disappointing, really, those signs that we had seen over the previous months. UK inflation, that CPI, that printed well above expectations. Headline CPI rose 0.8% month on month, 10.1% year on year. Expectations were for 9.8% and 0.5% on the month. So still in double digits. Really big hopes there that it would drop below into single digits for the first time since August. That was really not the case. And then core inflation, that held steady at 6.2%, 6% expected. And we also had actually PPI data was also higher than expected. So that's sort of factory gate prices, if you like, producer price index. Then we finally had retail sales, always widely watched in the UK because of the consumer importance. That was actually a little softer than expected, but the figures, we have to say, are volatile month to month. Sales have begun to flatline since late last year, but we kind of got to remember, if we think further out, real wage story that will improve over the coming months with this fall in energy costs after April, and then confidence actually is slightly picking up, which means really potentially the worst in the retail sector is behind us. Overall then for the Bank of England, it means they are of course interested mostly in inflation and those wage growth figures. They are sticky, wage growth figures strong, sticky inflation figures. And as I say, that's nailed on now, more than 90%, greater than 90% chance of a 25 basis point hike at the May meeting. And there's now around 70 basis points or so of total tightening over the next 4 meetings. So nearly 3 more 25 basis point rate hikes, which would take rates in the UK to 4%. Which sorry, we're up 4.25, so sorry, up to near 5%. And that has certainly helped the sterling cable especially outperform, along with those other currencies, those European currencies that we said. This aggressive repricing of the Bank of England tightening cycle, especially after the banking crisis a few weeks ago only, actually been echoed in the S&P rating agency, which moved their outlook for the UK sovereign rating back to stable from negative on Friday. And then just looking at the calendar for this week, pretty quiet actually. So risk sentiment could be an important driver for sterling this week. Just before actually we look at the technicals and cable, just want to show you a chart, if some of you guys weren't on here last week, which is this strong correlation which sterling has with the S&P 500, and so sort of global risk sentiment generally. You can see, I think last week, unchecked actually this week, so apologies, but that correlation, 1 month correlation between cables, so sterling against the dollar and the S&P 500 had risen above 80%, so 84% or so. So strong correlation, something to bear in mind, of course, as well as then this aggressive repricing in Bank of England tightening because of that strong data we saw last week. If we just go to the chart then, just bear with me 1 second, which is here. Yeah, you can see cable. So sterling against the dollar, of course. If we just go to the weekly, actually, you can just see, interesting, we're still kind of unable to close above that January top, which is at 124.47. You can see got close to closing above that, but not quite. Last week's close was what, 122.35. So just not above that close. That would really help bulls, I think, help us really to cement this nice move higher. You can see consecutive weeks of gains and just slowly plateauing, if you like, stalling around. Then you can see on the daily more clearly, stalling around 124.47. Interesting, I think Friday's price action was really interesting. Looked as though we could have been rolling over. People have been talking about this sort of head and shoulders pattern. You can see left hand shoulder, then head, and then the right hand sort of shoulder. And if you think that Friday candle was sort of pointing down here, then potentially that could have rolled over and it would have meant around 200 sort of pips or so of downside really. But we didn't have that. Buyers stepped in and negated really potentially that head and shoulders pattern, the support line around 123.60, I think. But if we do negate that and then push above 124.47, then potentially we look at, of course, 125 plus with that recent high at 125.46. That's on cable. Just then looking at very quickly the Eurozone PMI survey from Friday. That shed really quite positive light on economic performance in the Eurozone. We saw a pickup in the services activity, which is really boosting growth. That rose from 55, I think, to 55 or 56.6 actually. So pretty strong. Expectations were for fall actually to 54.5, I think. So it marks the highest reading in the service sector activity in a year. But we should point out it's kind of a picture of a divergence really between those services, strong services sector activity and the manufacturing sector. That headline PMI fell to 45.5. It was from 47.3. So that was actually its lowest reading since the pandemic. And if we look at the output PMI, that dropped sharply from 50.4 to 48.5. So in contractionary territory, that's that 50 marker boom bust level. Really new orders remaining weak. Most activities currently coming from actually reducing backlogs of work. So that reading actually, just to point out, so it's the output PMI is in line with production contraction. Aside from that, overall, though, generally sort of economies, the composite figure rebounding from really that desperate dark winter potentially that we were looking at. So decent rebound. Manufacturing weakness, of course, remaining a concern, and that's slightly dampening the upturn. As for Euro overall, we had over the weekend another speaker, another ECB member from Belgium, who said he wouldn't be surprised if the ECB would have to go to 4%. It's generally quite a quiet calendar for the Eurozone, but we do get Eurozone GDP on Friday. Consensus looking for a small quarter-on-quarter increase of 0.1%. This data, I kind of mentioned this with the US GDP, but slightly stale. Most really looking to those decent but diverging PMIs that we saw on Friday. Markets then pricing in 30 basis points of tightening in May, so next week, and a total of over 80 basis points by October. So quite a high bar really for a hawkish surprise, you'd kind of think going forward. Recent rhetoric from lots of ECB speakers has been implicitly really to embed that 25 basis point rate increase. And really, before the ECB can think anywhere about pausing, obviously, its policy rates, then they need to see evidence of wage growth and core inflation coming down. But core inflation especially is the big number, and that is still high and elevated. Just on, yes, euro dollar then, let's look at this. We can see it actually was very marginally the first down week actually last week in 7, as I say, pretty marginal, and we closed near the highs, even if slightly lower than the previous week. Again, though, there was no close above the January high, which is at 110.32. So interesting, again, couldn't quite close above there, but consolidation just below. If we look on the daily, decent underlying bull trend, really. Momentum suggests that any pullbacks really are buying opportunities at this point in time. Really a minor pause in the rally. Before then, we attack probably these highs at 110.75. That's the April high. If we do push above that, then we've got, if we just go back to the weekly, we can see the March 2022 top is at 111.84. Before then, we get the 200-week moving average at just above there at 111.95. So that's euro dollar. Okay, moving on to this week, we have the Bank of Japan meeting. A lot of focus on that. It's the first policy meeting, of course, under the leadership of the newly appointed Governor Ueda. It will also be actually the first meetings for the deputy new governors as well. Really a lot of focus, a big spotlight on them on this meeting after, of course, 10 years of Governor Kuroda. That said, central bank expected to maintain that current uber dovish really monetary policy settings. That means negative 0.1% rates, QQE with yield curve control, still flexibly targeting 10-year Japanese government bond yields at 0%, and then with that plus or minus 50 basis point tolerance range. That's really all expected, so no changes at all. Comments then from the new officials have suggested there's really no hurry to exit from the current policy. Ueda stated during his inaugural speeches a couple of weeks ago that Bank of Japan will continue monetary easing until the price target is stably and sustainably achieved. He also noted that domestic consumer inflation, which is currently around 3%, so high, he noted that that would likely slow going forward. And he then warned as well around a sudden normalization of policy. And also the deputy governors actually also said similar, that they will continue monetary easing to achieve the price stability target sustainably and stably. We've also had other officials actually saying they're not expecting an abrupt change in policy under the new governor. Of course, markets will be on the lookout. We'll all be on the lookout for potential clues about when, if the central bank could begin policy normalization, as that is actually expected by most economists, cited by Bloomberg, around some policy shift at the next meeting after this one in June. So interesting, really. Yeah, any hints around that will be key. Just on recent data releases, they've been kind of mixed, really, supporting this patient approach, if you like. We had the quarterly Tankan survey. That index deteriorated for the 5th consecutive quarter, fell actually to its lowest level since December 2020. But then we've had the large non-manufacturers sentiment survey actually printed at its highest in more than 3 years. Other data, again, mixed. Household spending disappointed, but then you've had that headline CPI, as I mentioned, at 3.2%, core CPI 3.1%. So all pretty mixed, and really pointing to continued pause, if you like, and the status quo with policy settings as they were, or as they have been. Interestingly, we did get reports, and we put this out, I think, in our weekly, our week ahead commentary, which is available on the website. Really, there was a recent press report that the central bank is mulling CPI projections for the new projections actually in 2025 between 1.6, 1.9%. So that would remain below the 2% price goal and really support the case for a delayed exit from easy policy. On then dollar yen, let's get to that. Probably best look at the daily. It's kind of, slight upward trend, of course, a little bit messy, and was just really trying to break the recent high at 135.13. If we do push above that, then obviously bulls would look towards 136, and then that 200-day moving average, which cut the upside, you can see there back in March, that 200-day moving average now at 137.03. Otherwise, if we do roll over, we've got near-term support. The blue line is the 50-day moving average, 133.77, and then the 100-day moving average just below that, 132.96. They should act as potentially as support if we do roll over. Obviously, if we do get really strong hints that the Bank of Japan is looking to move to more normal policy, then that could rapidly hit sort of that 132.96 level, and then we're looking at sort of 132 area around there. So that's dollar yen. Just then, other data this week, we do have US GDP growth. That's expected to moderate slowly to 2% actually from the prior 2.6%. That's released on Thursday. Yeah, 2.6% in Q4 last year, so 2% expected this year. Despite inventory drawdown potentially dragging on GDP growth, sort of personal consumption is expected to come in strong at 4% quarter on quarter annualized. And that's really the key driving force to sustaining GDP growth in the first quarter. We also then get as well CPI data, I said, well, core CPI deflator, really, I should say, and also the employment cost index. That's really the Fed's preferred measure of inflation, and also wage growth. So the median forecast for core PCE from economists surveyed on Bloomberg, 0.3% month on month, 4.5% year on year in March. That's versus in February, 0.3%, so month on month. So that's seen as being unchanged, but a slight tick lower, 4.6% in February. As I say, now seen at potentially at 4.5%. I think one thing to note here is rent-related components. We talked about those a lot with CPI, but they have a smaller weight in this core PCE measure than the core CPI calculation. So it means that the PCE number on Friday may not benefit as much as the CPI counterparts from the recent weakness in rents. Investors will also monitor closely probably the core services, excluding housing, that's a sub-index in the report. If you're eagle-eyed and like looking at economic data, then everybody or a lot of economists will be watching that number really to gauge underlying consumer inflation and those trends in the US. Or overall, then, that report on Friday should confirm kind of the ongoing process of gradual disinflation. So that's falling inflation in March, but the core run rate is still set to remain quite high and above the Fed's target. In fact, I just think we do have a chart for this. Here, you can see then it is falling, but it's still elevated and still above the sort of 2% target of the Fed, which you can see here. So way above that. And you can just see sort of the monthly numbers as well there. So still high, still elevated, still sticky, and really forcing that 25 basis point hike. One more of those left before then cuts, which are priced in. There's at least one full 25 basis point rate cut priced in for the Fed funds rate, and around then a 50% chance, I think just a bit lower then, of another later this year after, as I say, that baked in 25 basis point rate rise in May. Okay, let's now move on to, we've got time just quickly to move on to earnings. Just bear with me 1 second. Just pull up the couple of the charts. Well, we got the DXY actually. Just look at that. So again, I'm sure a lot of you know, we talk about a lot the DXY chart. Obviously, it's an index against 6 of its major trading partners, and the euro has by far the biggest weighting, around 56, 57% or so, I think. Next is then the yen and sterling, around 13, 12, 11% or so. So this chart really is a mirror image, if you like, if you flip it over for euro dollar. So you can see we're just sort of tracking lower. We were trying to push out. We've got this sort of descending channel then, of course, in DXY. We're slightly out of it. If you just see slightly out of the sort of band, the top upper channel, if you like, part of the band, sorry. But we're rolling down and lower again. Those lows corresponding with that sort of 110 level and above on euro dollar. So the lows at 100.82, that's from that low in February, and you can see we've talked about tapped it last week and then bounced. So potentially that level strong support going forward. Okay, let's move on to earnings this week. We said we'll get a big reality check. I think, as I said, 170 members of the S&P 500 reporting results. A lot of those will be blue chip. Today we see we might have just got Coca-Cola's actually already. That's a global gauge on the consumer. And we also had, I would check, First Republic Bank, which was, of course, bailed out by those other much bigger banks during the crisis a few weeks ago. Then moving through the week, we get 5 of the 10 biggest companies in the MSCI All World Index report, including, of course, I've mentioned Microsoft, Amazon, Alphabet, Meta, and Exxon, actually all up this week. Just focusing on the tech giants, though, if earnings misses on already revised down earnings estimates, that could, of course, threaten stock prices and, of course, especially the NASDAQ 100. But the focus is definitely on these 4 stocks at least. They make up nearly around 40% of the index. And that means they'll have a big impact. I think that's with Apple as well, though, just to bear in mind. They report in a couple of weeks. But that means, of course, yeah, big impact on the tech-heavy index. And just remembering as well, actually, we highlighted a few weeks ago just how these dominant stocks really have surged, obviously, in the first quarter. And yeah, I think Apple's valuation, just as an aside, increased by nearly 600 billion or 30% in the past 3 months. As for these 4 stocks, yes, what is Wall Street expecting? So they expect actually another tough quarter, with only Microsoft being the only company actually of these 4 to forecast to report EPS growth after suffering falls in the last 2 quarters, while the rest of the group is anticipated to report another quarter of declines. In fact, actually, analysts are expecting tech profits earnings to see the biggest drop since 2009, with big tech's customers obviously seeing a curb on spending on software, cloud, and advertising services, given that they're pinched by, of course, high inflation and higher borrowing costs. Certainly the focus then will be this week on commentary around how cost reduction measures such as mass layoffs have helped ease margin pressures. Tech stocks in the S&P 500 general, they're trading at 25 times prospective earnings. Many sort of watchers think this is too expensive, given earnings growth is going backwards, really, with average tech earnings growth down 37% further out. Just looking at the specific companies then, so let's look at Microsoft first. Just bear with me and we'll look at the chart as well as some of the expectations. That's the chart for Microsoft. Hopefully you can see that. Reports Tuesday after the close, expected to report actually a decline in PC sales and a slowdown in cloud services. That will likely continue to weigh on the top line, with consensus forecasting the smallest constant currency revenue growth since 2017, actually. There will be no doubt some focus on AI enhancements to its search engine, Bing, but they're not likely to translate to sizable sales growth for the company in the near term, at least, although forward commentary certainly will be watched, very closely watched, given Bing is touted to potentially threaten Google's search dominance. That then could be a catalyst for higher forward revenue from advertisers going forward. Technically then, on the chart, you can see just quite nice, again, bullish consolidation for us after this big break higher. As long as we can track sideways, we're tracking sideways, sorry, but as long as we can hold above that 100-week moving average for us then at 277.46, then potentially then we would look to go higher. And then near-term resistance is that near-term high at 292. If we just go to the daily, you can see us tracking sideways. But as I said before, yeah, the longer we track sideways, the bigger the range breakout will be. So again, that near-term high at 291.76 is key for more upside. If we can break that, then we probably look towards what 294.18, which is that mid-August high, potentially. Okay, that's Microsoft. Otherwise, yes, we roll over near-term supports at 281.64. Then we roll over back towards sort of around sort of 275 or so. Next up, we then get Alphabet, I think, which is obviously Google's parent. That reports also on Tuesday, growth likely to remain dull with a pullback in ad spending, particularly by the financial sector, adding really to headwinds, while its core search ads business is expected to remain pressured by really the whole macro uncertainty. That's a very quick nutshell of the fundamentals expected. The chart you can see, let's just have a look at the weekly. Okay, we've got support probably at the 50-week moving average around 103.43. And then if we look at the daily, yeah, just sort of bobbing about. Again, that high, near-term high at 109.58 is strong resistance. You can see we didn't break really and close above that February high, early February high at 108.82. So just around 109, very strong resistance looks like for Google for more upside. But if we can break that, then potentially we've probably got 112.64 as a target for bulls above. Otherwise, roll over, then we've got the 100-day moving average, interestingly, which sort of capped that resistance there, but then acted as support. So potentially that's key support for Google. That number at 101.48. That's the 200-day moving average on Google. Okay, then let's just briefly look at Meta. So obviously Facebook's parent. Sorry, that's Microsoft. Where are you, Meta? Sorry, just bear with me 1 second. Let's extend this. Having a brain freeze here. Sorry, Meta. Sorry. Yeah, slight brain freeze. We all get them. So Meta, what are we looking at? What are analysts looking at? Wall Street analysts? Well, potentially could be kind of a shining light for big tech. They report on Wednesday after the close. Operating margins widely expected to expand by as much as 20% potentially. See Meta returning to growth after 4 quarters of declines. Weak engagement on the Facebook app remains a kind of a big drag on ad impressions growth, but there has been increasing contribution from some of the other apps, Instagram, WhatsApp, and messaging ads as well, with the messaging ads, obviously. Focus will be on that translating really into the main numbers. Doing well, Facebook, you can see that really. Let's have a look at the weekly chart. Really strong move up from those October lows, and obviously on the year as well. Upside potentially looking at that 200-week moving average and the 100-week moving average converging around sort of 231.72, you can see, or 232.51. So that's major resistance, looks like, to the upside, and then potentially well, near-term resistance at 222.11 as well. That's a near-term high. If we do roll over, then where do we have? Probably this high at 205, and then around sort of 197.90, so around 200, always a good level. That's the 50-day moving average at 194. Okay, finally, Amazon. Just bring up the chart. You can see the bounce there from last week up to the 50-week moving average at 107.75, so just above the close, but a strong close from last week. Amazon widely expected actually to report its weakest quarterly revenue growth on record, actually. They report on Thursday. Really, until we see sort of cloud services momentum re-accelerating, it's possible operating margins will remain under pressure. So technically then, you've got that nice move higher actually on Friday, up over 3%, you can see, but then tapping then the 200-day moving average at 107. So you can see that cap the upside previously really strong in August, and then we fell lower. And then also on earnings, you can see that gap higher, closed above that 200-day moving average then, but then swiftly fell lower. So really interesting that we're capping that 200-day moving average at 107, and then whether we fall back or not, like we have done previously. Okay, hopefully that's been of some use to everyone. Haven't had any questions, I don't think. Let me just check the box. No questions. Please do ask questions next time, or if you have any now, should have said, always keen to answer anything you have, and even the sort of structure of this webinar, of course, if you want to look at other assets, other markets, other currency pairs, miners, as well as some of the other majors. We always try to look at all the majors really, and then whatever central bank risk event, big risk event is taking place, of course. So the Aussie, the Kiwi as well, the Loonie, against the dollar, of course. Please do follow us on social media. You can see here, and then also we write, of course, our daily commentary on the website, which has really the overnight moves from a UK perspective, but the overnight moves in the dollar, in equity indices, and then sort of the day ahead look at market thoughts, and also a chart of the day. Okay, hopefully please do come back to us, and we'll speak to you this time next week ahead of, or we'll review, of course, some of the earnings, of course, and then look ahead to the ECB, the Fed, and non-farm payroll next week. Huge week, and a huge week of earnings, and a lot of data to look forward to. Okay, take care out there, and we'll speak to you next week.